Welcome everybody to part 2 of how cryptocurrency lending and borrowing works. Previously in part 1, I explained what lending is and how does it work. So please do watch part 1 before you watch this video. A link to that video should pop up here right now and I'll also leave it in the description below. Okay, in part 2, we will dive deeper and explain everything about the different types of crypto loans and risks involved with them and a lot more, guys. So without any further ado, let's get started. Crypto loans can be divided into two broad categories: custodial crypto loans or CeFi. When it comes to centralized finance or CeFi loans, a centralized authority takes control of the collateral. CeFi loans are custodial ones where the trader has no access to the collateralized assets because the lender has access to the private keys of the collateralized assets. If you compare custodial crypto loans with traditional loans, you will still notice that they are affordable and easily accessible compared to traditional ones. The only downside here is that there would be a central authority to determine all the loan terms. Currently, more than 80% of the crypto loans are custodial, but with the advancement of decentralized platform, this ratio is drastically changing. Non-custodial crypto loans. There is no central authority to control the terms of a decentralized finance loan or DeFi, which are non-custodial. All the terms are under the control of smart contracts. If a trader is taking up a DeFi crypto loan, they would be able to have to control the private key of their assets unless they are defaulting on their crypto loan. You cannot get a loan for any fiat currency on DeFi platform. You can only receive loans in different cryptocurrencies or even get a stablecoin loan that can be exchanged for cash. The interest rates on DeFi loans aren't as high as compared to the custodial crypto loans. All the protocols are accessible to anyone as they are put on the blockchain where everything is transparent. There is no need to go through any verification process on DeFi platforms, and even the interest rates will be less than CeFi platforms. There's no need to worry even if you're on the lender's side on the decentralized platform. Smart contracts make sure that the loan is repaid. Whether you're thinking about taking up custodial or non-custodial loans, there's certain things that you need to take care of. You should be aware of certain risks that are involved in crypto loans before you take one. And that takes me to the risks involved in crypto loans. If you look at the assets in the traditional finance institutions, there's always a federal insurance for every event of an exchange. Also, there's no federal insurance on any of your crypto assets. If any failure occurs during the exchange process, then you cannot blame anyone. There are three primary risks involved in crypto loans that you should keep in mind. Number 1. Technical risks. Everything in the crypto trading world happens in the digital world. There is a considerable risk of any technical problems in the protocol or any hacker taking control of the protocol. As all these activities on DeFi are only governed through algorithms, the risk gets higher in non-custodial loans. Other than that, if there's an issue with the smart contract, the entire platform can fail and result in the loss of crypto assets. Number 2. Counterparty risks. When it comes to traditional banks, there's a rule to maintain a certain level of liquidity. This used to be the case, but as of the pandemic, banks are not required to maintain a certain level of liquidity. But this is not the case in the crypto world. The investors providing crypto loans to the borrowers are not subject to this requirement. If there's a market crash by any chance, then there would be a considerable number of clients defaulting on their loans. On the other hand, if there's any case of platform exploit or breaking scenario, there would be no liquidity available for returning the collateral at stake by the borrower. Number 3. Forced liquidations. To prevent the issue of illiquidity during a market crash or downfall, the lending platforms issue forced liquidations or margin calls. Suppose any crypto asset's value drops to a certain point when a significant amount of the borrower's LTVs or loan to value is too high for the lending platform to maintain. In that case, they will instruct the borrower to increase the value of the collateral at stake, or they may have to face liquidation. If the borrower doesn't meet this margin call, the platform will liquidize enough collateral that the borrower's LTV is back to the maximum ratio allowed. This is a risky scenario for both the trader and the borrower. Okay Adnan, thanks for the information on the risks, but what are the crypto lending rates? Every platform has different lending rates for cryptocurrencies, so your returns will be entirely dependent on the platform that you choose. Every crypto lending platform has a specific ROI and certain risks are also connected with it. This is why you should consider choosing multiple lending platforms to lower your risk and also have some diversity in your investments. You will find different lending rates for different cryptocurrencies on various different platforms. Usually, the lending rates for cryptocurrencies are 3 to 8%, while the rates for stablecoins vary from 10 to 18%. So, the best strategy is to fix a platform for any particular coin by comparing the returns on different platforms for that specific coin. With this strategy, you can optimize your returns and get a better ROI. Now, you might be wondering what stablecoins are. So, let me give you a little bit of a brief explanation. Everyone will agree that cryptocurrencies are highly volatile. To reduce the amount of risk and also offer price stability, stablecoins are issued. These coins are backed with reserve assets. Now, what does that mean? The value of a stablecoin is pegged with the value of a non-crypto asset. It can even be pegged with the value of any fiat currency like the US dollar or anything like that. This adds stability even to the crypto world because the value of a dollar or any other fiat currency is not highly volatile, just like crypto assets. The main reason why stablecoins gain a massive amount of traction is because it provides stability like the fiat currencies, instant processing, the privacy of payments, and security like cryptocurrencies. So it's like the best coin to combine both worlds. Alright, how do crypto loans without collaterals work? Another option is to go through a decentralized platform for crypto lending. Crypto loans without collateral are also known as unsecured crypto loans. The borrower can have short-term liquidity and pay back the loan amount in cryptocurrency or fiat currency. Here, the idea is to borrow the loan directly from a lender by keeping cryptocurrency as collateral instead of staking other assets like properties or gold. Flash loans are currently the most popular unsecured loans on DeFi, where you don't have to stake anything for collateral. The only thing that you need to be careful about is having enough knowledge about crypto and DeFi before taking up a flash loan. Flash loans are instant ones that are controlled directly by smart contract. You should perform thorough research before you move towards any unsecured loan. What do you need to do to get a crypto loan? Guys, you don't need to go through a lengthy process like you have to go through during a traditional loan. No one will check your credit score or income slip when you're taking a crypto loan. The only thing that matters here is that the amount of loan you will receive will depend upon the amount of collateral you will be allowed to use. The loan to value or LTV ratio is applicable. It is the ratio between the approved loan amount and the value of the collateral. As crypto markets are highly volatile, the LTV ratios are usually low on cryptos. So, if you're putting $5,000 worth of crypto as collateral and receiving a loan of $3,000, then your LTV ratio is 60%. So, you don't really need any documents for getting a crypto loan. You only need to have sufficient crypto assets for staking them as a collateral. Now guys, let's look at some of the pros and cons of lending cryptocurrencies. Pros. Crypto loans are accessible to every individual without looking at any income slips or opening an account in the bank. Usually, the borrowers can receive the loan within a few hours. Crypto lending is a much safer option as compared to P2P lending option. The crypto assets used as collateral in crypto lending are highly liquid. If you go with automated lending platforms, earning passive income through crypto dividends is effortless. The borrowing rates are pretty low on lending platforms as compared to other bank loans. Cons. Crypto assets are highly volatile. However, you can lend stable coins on different platforms to overcome this issue. For taking part in crypto lending activities, you have to place your crypto in a digital wallet. The problem here is that digital wallets are less secure than physical wallets like a Ledger Nano Pro. The security of a platform is also becoming a massive concern with an increase in the cases of crypto thefts. Specific platforms only allow you to stake your crypto for a fixed period. You must choose a platform that doesn't have fixed period conditions. Alright guys, that wraps up this two-part series. Now you know how cryptocurrency lending and borrowing works. If you now want to know the top crypto lending platforms, you're in for a treat! Very soon, I will be uploading a video on the top 11 crypto lending platforms to earn passive income in 2022. Remember, the right platform can make things easier and also increase your investment yields to the next level. If you're interested in that video, then all you gotta do is smash that subscribe button and click on the bell icon so you don't miss when that video drops. Simple, isn't it? I would also appreciate it if you could smash that like button and share this video with your family and friends. I would recommend you to check out the first video of this part, which will give you a clear understanding of what crypto lending is and how it works. For now, my name is Adnan Arif and see you in my next video.